Determine how the entity should account for the financial instrument to be issued. 10 marks. For 10 marks, there are two parts, A and part B. Each part is around 5 marks. Your answer should be around 5 to 6 points for each part of the questions. First, we'll look at part A. The company is considering the following two alternatives in obtaining external funds. The entity is to issue a financial instrument for principal amount of $500 million. The interest rate will be 16% per annum for the first 10 years, payable in arrears, and 0% in subsequent years. The entity would have no obligations to repay the principal. For every examination questions, issue requirement comments. You must identify what's the issue, and you must provide the relevant requirement. At the same time, you must provide relevant comments, how this affects our financial statements, in particular, how this affects profit and loss, how this affects our statement of financial positions. The issue of this financial instrument, we need to consider whether this is a financial liability or whether this is an equity instrument. An equity instrument only if it's not a financial liability. What is the meaning of financial liability? You have to consider the definitions of financial liability. We have to consider the contractual arrangements. In this case, although the company do not have obligations to repay the principal amount at the end of year 10 or year 11 or year 12, because they're paying the principal amount over the 10 years with a high interest rate. Every year they have to pay 16% of $500 million for 10 years. In total, the entity is paying $800 million. They're paying for two items. The first item is a payment of the interest, which is equals to $300, and the repayment of the principal, $500 million. The substance of this arrangement is they are not paying the principal at the end of year 10 or year 11 or year 12. It's because they're paying the principal over the 10 years. In this case, it should represent a financial liability, a contractual obligation to deliver cash. What cash they've delivered over the 10 years? Every year they must pay 16% for 10 years. It's paying for the interest and the principal. In substance, this represents a financial liability. The 16% we call this as coupon rate or contractual rates. That means every year they must pay 16%. But effectively, the interest is not the $800 we mentioned just now. The $800 they pay, based on 16%, they're paying for two things, interest and the principal. Effectively, the interest is equals to 9.6%. This 9.6%, we call this as effective interest rate. In total, you should be able to get 5 marks. 5 relevant points to the questions. First, you must tell the marker what's the issue. The issue is whether it's a financial liability or equity instruments. We must consider the substance of the contractual arrangements. Generally, we call this as equity instrument if it is not financial liability. Then you have to check whether it's a financial liability. It is a financial liability because it represents a contractual obligation to deliver cash. Every year they must pay 16%. In total, they have to pay $800 million. 16% we call this as coupon rate. But effectively, the interest is only $300. This $300 over 10 years, effectively is only 9.6%. We call this as effective interest rate. Can you look at suggest answer? You must answer the question. Do not just copy from the learning pack. Apply the question by using the dates, by using the amount, by using the company name. First, you must identify what's the issue. The issue is that the financial instruments represent a financial liability because the entity have a contractual obligation to deliver cash, i.e. 16% for 500 for 10 years. In total, the entity have to pay $800 million. We cannot simply say this $800 million is paying for interest. The interest payment is too excessive. The 16% interest contractually, they call this as interest, but in substance, $800 million they're paying for the principal and the interest. The financial liability should not be classified as fair value P&L, since the financial liability is not considered as held for trading. Normally, this financial liability should be measured at amortized cost. If you know when you're going to pay, how much you're going to pay, it will be measured at amortized cost. We'll discuss this shortly when we talk about IFRS 9. Initially, it must be measured at $500 million. After initial recognition, it will be measured at amortized cost using the effective interest rate method. We are not given the effective interest rate. You have to calculate yourself. The effective interest rate is at 9.6%. That's all for part A. Can I take this out to do a further discussion? Part A, $500 million at 16% per annum. We mentioned just now this is considered as a financial liability because it represents a contractual obligations to deliver cash. Based on we understand cash flow, year 0, the company received $500 million. Year 1, the company have to pay 80. Year 2, they have to pay 80. Year 3, they have to pay 80, all the way to year 10, 80. If you add up this column, the net amount is $300 million. This $300 million we discussed just now is considered as an interest expense over the 10 years. So if it's an interest expense over 10 years, we have to consider how much the interest rate effectively. A little bit of discounting, discount, present value. $1 now is equal to $1. $500 million now is equal to $500 million. We have to consider what's the interest rate to discount all these so that present value is equal to 500, which a NPV is equals to 0. In this case, it's 9.6%. For other paper, you call this as internal rate of return. We call this as effective interest rate. How do you calculate this 9.6%? It's not given. Either you use the internal rate of return formula or use a financial calculator. Generally, I advise candidates to get a financial calculator. With the financial calculator, you key in year 0 cash flow inflow, year 1 outflow, year 2 outflow, And after that, you'll press the button called IRR button. You will see this 9.6%. Every year, we are paying $80 million, 16% multiplied by 500. This 16% 500, the coupon rate. Coupon rate is always used to determine the cash flow. But when you account for interest income, interest expense to P&L, it must always based on the effective interest rate. The $800 we pay, but effectively it's only $300 interest. The $500 we are not paying for interest, we are paying for the principal. You must account the transaction based on the substance rather than the legal form. Just now we concluded that this is a financial liability at amortized cost. Year 1, the issue of the loan with debit cash, credit loan, is equals to $500 million. And we must account for the interest expense. Interest expense is always based on the effective interest rate multiplied by your financial liability. Effectively, we calculated just now is 9.6%. Borrowing of 500. The first year interest recognized in P&L should be equals to 48. This 48 is the interest that we must recognize in profit and loss. But the interest payment, which is the cash flow, is based on the coupon rate multiplied by the par value. 16% multiplied by 500, $80. The $80 partly is paying for the interest, partly is paying for the loan. If we are paying for the loan, we have to reduce the loan. After the first year, our loan will reduce by 32. 468. This will be the carrying value at the year end. That's the first year. Let's look at second year, year 2. Last year closing will become this year opening. We should have a broad four figure of 468. We have to redo everything again in the second year. Interest cost effectively every year is 9.6%. Multiplied by loan outstanding for the year is 468. The second year interest should be equals to 44.928. Can I just put as 45? But every year we're paying $80. But in substance, we're paying for interest is only 45. The balance of 35 is paying for the loan. If you're paying for the loan, we must reduce the loan. The loan should reduce by 35 in the second year. After the second year, loan amount will be equals to 433. If you continue this for another 7 more years, when you come to year 10, this amount will become 0. Every year paying 80. The $80 we are paying every year, we are not just paying for interest. We are paying for the interest, we're also paying for the loan. The loan will pay down over the 10 years. When you come to year 10, this will become 0. In the first year, we have to credit cash. The cash we pay every year is 80. And we have to debit interest to P&L, 48. $80 we pay, 48 is paying for interest. How much you are paying for the loan? Financial liability is 32. This 32, we call this as amortized cost adjustment. We'll discuss this later on. That is the first year. Second year, we still pay $80. We're only paying for interest is 45. But interest should be lower as compared to last year because the loan becomes smaller. The $80 partly you're paying for interest is 45. Partly you're paying for the loan of 35. That's all for part A. Part B, study the question carefully, identify relevant issue, provide relevant requirement, provide relevant comment, discussion working, how this affect profit and loss, how this affect statement of financial positions. The issue of redeemable, convertible, preference share with a principal amount of 500 million, the company would pay a fixed dividend of 8% per annum cumulative. So this payment of fixed dividend, 8% represent the coupon rate. By the end of year 4, from the date of issue, the company will have to redeem the preference share. Anytime during the 4 year, the preference share could be converted into 100 million share if the holder exercise the conversion rights. Investors have the rights to convert $5 into 1 share. $5 into 1 share means the right to buy share, or sometimes we call this as call options. Without the conversion rights, the company should be paying dividend of 10% per annum. We call this as effective interest. This is a convertible preference share. A convertible preference share normally in exam is a compound financial instrument. The company have 2 obligations. The first obligations is to pay back the principal $500 million and to pay the 8% dividend every year. That represents a financial liability. The second obligation is to allow the investor to convert the preference share into ordinary share. Every 5 preference share can be converted into 1 ordinary share. This represents an equity instrument. This is a compound financial instrument. It's a mixture of liability and equity. Then we must account separately. Must always calculate the liability first, and the balance is your equity. Can we look at suggested answer now? From the perspective of the entity, this entity is an issuer. This convertible preference share represents a compound financial instrument. To the investor, it's a hybrid contract. It's a host contained and embedded derivative. We'll discuss that later on. To the issuer, this is considered as a compound financial instrument. Number 1 is a financial liability. It represents the contractual obligation to pay $500 million and 8% dividend for 4 years. Number 2, it represents an equity instrument because the conversion options, or call this as call options, allow the investor to convert $5 preference share into 1 ordinary share. In accordance to AS 32, we need to account this convertible preference share, which is a compound financial instrument, separately as liability and equity. We must always calculate the liability first. Liability is the present value of the future cash payment. Number 1 is assuming dividend will be paid at the end of year 4. The second assumption is dividend is paid annually. Normally in exam, the second one is the more likely treatment. After we account for the financial liability, the balance is considered as equity instrument. In this case, should be the balance of 31698,654. 5 marks. For part B, first you must tell the marker this is considered as a compound financial instrument. because it contains two components. Must account separately as liability and equity. Third, must always calculate liability first. Fourth, how much is equity? This answer, can we go one step further to show the detailed working? Part B, redeemable convertible preference share at 8% per annum. Year 0, Year 1, Year 2, Year 3, and Year 4. Year 0, debit cash, we issue a preference share of $500 million. Credit preference share capitals, but this is a financial liability. Credit the conversion rights or call options. So we have to split this 500 into these two components. Always calculate the liability first, and the balance is the call options. Contractually, we must pay 8% per annum for year 1, year 2, year 3, year 4. 8% of 500 is equals to 40. Contractually, it's 40, 40, 40, 40, plus the 500 if it's not converted. We have to discount this to present value based on the effective interest rate at 10% per annum. If we issue a normal preference share, we have to pay a 10% dividend. This is the real borrowing cost of the entity. Over 1.1 to the power of 2, 1.1 to the power of 3, and 1.1 to the power of 4. This amount will be equals to 468.3. Here, 40, 40, 40, 540, 468.3. The balance will be considered the call options. 500 minus 468.3. The balance represent the conversion option, conversion rights, or call options, whichever you call it. This is the initial amount at year 0. At the end of year 1, we must adjust the preference share capitals to amortized cost. We must increase this by 10%. The effective interest cost that represent interest expense to profit and loss for 6.8. But the interest payment is based on the coupon rate. Contractually, we have to pay 40. After 1 year, preference share capitals, which is a financial liability, will be the sum of these, equals to 468.3 plus 46.8 minus 40 equals to 475.1. This 475.1 represents the amortized cost. The second year, again, we must account for the interest in profit and loss expense. The interest expense is always based on the effective interest rate of 10%. 475.1 multiplied 10% equals to 47.5. But the dividend payment is based on a fixed dividend rate of 10%. After the second years, preference share capitals increase to 482.6. This will be the amortized cost as well. Every year we must adjust to amortized cost, amortized cost, amortized cost, amortized cost. When we come to year 4, preference share capitals, if it's not converted, will come back to 500 at the end of year 4. Call option is the equity. Equity every year will be the same. Do not adjust equity. Call options 31.7, call options 31.7. When we come to year 4, call options is 31.7. For equity, we do not remeasure. Refer to the balance sheet at year 4. Under the equity, share capital equals to X dollar, retained earning X dollar, call options equals to 31.7. Under the liability, we have a preference share capitals. This is a financial liability, $500 million. This is the balance sheet at the end of year 4. There are two scenarios here. The first scenario is no conversions, paid in cash. Debit the preference share capitals, 500, credit cash, 500. If it's no conversion, pay in cash, credit cash. Second scenario is conversion, share issue for the conversions. Conversion, share issue. Debit preference share capitals, 500, and credit share capital, 500. Settlement share, credit share capitals. When the preference share is converted into ordinary share, we may do a transfer from call options to share capitals if there's a conversions. We may do a transfer, but in exam normally you should do a transfer. Debit call options, 31.7, and credit share capitals, 31.7. This is the entry that you may pass, is to transfer from call option reserve to your share capitals. In accordance to AS32, you may do so. Because there's no difference, whether you're going to put under call options or put under the share capitals is still under the equity. But normally for examination purposes, the suggested answer given by examiner is that they will do a transfer if it's converted. If it's converted, normally you should do the transfer from options to share capitals. For this question, I'm using figures journal entry to discuss the basic requirement, the general principle of the relevant standards. From the calculations, journal entry, working, after having good understanding of the requirement of the relevant standards, in the exam, you are able to offer comments, advice, explanations as required by the questions. Bear in mind, you must put those figure journal entry in sentences for examination purposes. Please refer to page 581, question 20.24. This is a Module 11 questions from Pilot Paper 2021. This question is to discuss the accounting for compound financial instruments. Study the questions, understand the issue. We're going to discuss this question shortly. On 1st April 2017, PSL issued an 800 million convertible bond at a coupon of 2% per annum, which is payable annually in arrears for the coupon interest. The year end is December, hence the bond is issued during the year to 31st December. We are looking at 9 months for this year. The convertible bond have a maturity at 31st March 2022, is a 5-year bond. The holder of the bond are entitled to redeem at par together with any accrued interest on 31st December 2017 or upon maturity date. The holder of the bond are entitled to convert the bond into 400 million share of PSL on or before the maturity date. $800 million bond can be converted into 400 million share. Every share is $2 each. On 1st October 2017, certain holder exercised the option to convert into share for a principal amount of $200 million, which means 25% of the bonds were converted into share. At the date of the issue, the market interest rate without the conversion rights is equal to 6%. This 6% represents the effective interest rate. The functional and presentation currency or PSL is Hong Kong dollar. If the functional currency is Hong Kong dollar and the bond is issued at Hong Kong dollar, when the conversion option is exercised by the holder, it will involve fixed amount of cash for fixed number of shares, which means the conversion options will meet the definitions of an equity instrument. This is the accounting issue for this question, Part A and Part B. PSL prefer to apply fair value options to instruments if it is a hybrid contract. The fair value of the conversion options is categorized at level 3 of the fair value hierarchy in accordance to FRS 13. We are given the fair value of the relevant component. 1st April 2017 is the date of the issue. The fair value of the liability is equal to 665, and according to the question, the fair value of conversion component is equal to 110. But you have to think about what's the requirement of AS32. For Part A, 1, explain how the convertible bond will be accounted for under the above scenario. According to the information given to us, the convertible bond is considered as a compound financial instrument, financial liability, and an equity instrument, in accordance with HKAS 32. The $800 million, we have to split between liability and equity. The liability is equal to 665. This 665 given to us is equal to the present value of the future cash payments at 6% per annum. If you try to work it out, you should be able to get the 665 yourself. For equity, we do not use the 110. For compound financial instruments, equity will represent the residual amount. 800 minus 665 equals to 135. For Part A, 2 marks, you just need to explain that this is a compound financial instruments in accordance to AS32. For Part A2, when we prepare the journal entry with detailed calculation for the issue of convertible bond at 1st April 2017, we need this figure for discussions. And for Part A2, prepare the journal entry for the partial conversions of convertible bond on 1st October 2017. Let's do a discussion on this separately. Part A, the convertible bond represents a compound financial instruments, which means it's a financial liability and equity instruments. That's for A1. At the date of the issue at 1st April 2017, debit cash, $800 million. Credit financial liability, in accordance with questions given to us, is $665 million. However, if the question asks you to calculate this $665 million, this represents the present value of the cash payment at 6% per annum. And the balance represents conversions right, which is equity instruments of 135. We should not be using the 110 given to us. If it's a compound financial instruments, the equity will represent the residual amount. And the question mentioned that a portion of this was converted into share on 1st October 2017. We need to know what's the positions of this item at the date of the conversions. Accordingly, the convertible bond must be accounted for interest to profit and loss at 6%, 665 multiplied at 6% for 6 months, which is 19.95. And the interest is not paid at the date of the conversions. Liability at 1st October 2017 before the conversions, including the interest component, will be equal to 684.95. Equity, we do not remeasure. But financial liability, we need to remeasure at amortized cost. Hence, equity will remain at 135. The question mentioned that the conversion involved 200 million over the 800, which is equals to the 25% converted. Multiply this by 25% equals to 171238. I round to 3 decimal places. And the equity, 33.75. Debit financial liability, debit the conversion rights, and credit share capital. The total of 33.75 plus 171.238 equals to 204.988. These are the entries that you must pass for the conversions. Please refer to the suggested answer now. Part A1. For 2 marks questions, we are required to explain the accounting treatments for the convertible bond based on the information given to us. Given the conversion result in delivery of fixed number of shares, the conversion feature will meet the definitions of equity instruments. Hence, it represents a compound financial instruments, a financial liability, and an equity instruments. Part A2, prepare the journal entry for the issue of the bond and the conversion of the bond. At the date of the issue, the $800 million we must split between financial liability and the balance is an equity instruments. If you are not given the 665, you should calculate 665 yourself. Take the $16 million over 1.06, $16 million over 1.06 to the power of 2, until the year 5 is 816 over 1.05 to the power of 5. Add out these 5 years will be equals to $665 million. At the date of conversions, which is the 25% converted into share, reduce the liability, reduce the conversion options, transfer to share capitals, 204.99. Same entry that we discussed earlier on. For part B, assuming the functional currency of PSL is renminbi, we are required to explain how the convertible bond will be accounted for under this scenario. If the functional currency of PSL is renminbi and they issue a convertible bond in Hong Kong dollar, then the conversions options does not meet the definitions of equity instruments. In order for the conversion option to be an equity instrument, it must involve the fixed amount of cash for fixed number of shares, which means this will be considered as a derivative liability. The convertible bond represents an hybrid contract which contains a host plus an embedded derivative. For these questions, the company do want to account for this hybrid contract at fair value through P&L, which means the host and the embedded derivative do not account separately. You'll be accounted as one whole contract at fair value to P&L for these 4 marks. For part 2, I leave it to you. You can refer to the answer for part 1. For B1, if the functional currency of PSL is renminbi, the conversion options does not fulfill the definition of equity instrument. It's not involve fixed amount of cash for fixed number of shares. Accordingly, the convertible bond represents a hybrid contract which is considered a financial liability with an embedded derivative. And the question mentioned that PSL preferred to apply the fair value options for the convertible bond, which means both the debt components and the embedded derivative will be accounted for as a whole at fair value through P&L, which means at the date of issue is equals to $800 million, 1st April 2017. We have to adjust to the fair value at the date of conversion of 1st October 2017. Any gain or loss should be recognized in profit and loss. For part A, if the functional currency of PSL is Hong Kong dollar and issue Hong Kong dollar bond, the conversion option represents equity. For part B, if the functional currency of PSL is renminbi and issue a convertible bond in Hong Kong dollar, then the conversion option is not an equity instrument, it's a derivative embedded in the host contract. The main issue for this question is whether the conversion option is an equity or liability. You have to refer to AS32 to distinguish whether it's a liability equity by considering the factors given in the questions. We come to the end of these sessions on AS32, presentations of financial instruments.